Welcome everyone to another edition of On Track, and this is the end of March 2021 edition. So all the news is up to date to the date of recording, 29th of April. The performance figures are to the end of March. Let's dive in, and firstly for anyone, this presentation is designed for clients of McGregor Wealth Management, particularly those using the care investment methodology and portfolios. For anyone else watching this, feel free to get as much out of this as you can, but please don't act on anything we talk about in this without getting advice that's specific to your own circumstances. Today we're going to cover, as usual, the latest economic news. We're going to put that into context and what's happened on the markets as a result of that news and other developments. We're going to update all those key markets, look at our returns, talk a bit about what's happening around vaccination progress. That's a pretty critical issue in terms of what to expect next. We're going to talk about how this was the quickest recovery from a major share market economic crisis in history and why. Also going to touch on a topic that lots of us talk about, the hot property market, whether that's sustainable, what's caused it, and how it's come about, what's happening around Australia. And as usual, put all these things in perspective for you. So let's have a look at the news highlights. And the vaccines are continuing to roll out around the world. I'm going to take you through some of the stats around that shortly. Australia's underway, but it's fair to say we're not winning this race. Fairly slow start. I think we were cautious. We didn't think we had to rush into it because we were so successful early on. And I'm watching countries like Australia and New Zealand who are going to be very successful early, but maybe slower later. I'll talk a bit more about that. We've seen, as I'm going to air, a massive spike in the last few days in COVID cases in India. They've got some real challenges there, which is indicative of the split world that we're seeing. We're seeing declines in developed countries as vaccination rolls out, but increases in developing countries. So a real issue the world's going to have to manage. And good to see Australian and other developed countries chipping in and trying to get equipment across to India. And they're really going to have to do that with vaccines as well. If we want an open world, those developed countries will have to chip in not only for equipment to deal with COVID extreme cases, but also vaccines to stop the spread in those countries, and hopefully we'll see that development. We're seeing lots of good economic data. I've got a couple of slides here and more to come. The PMIs, these are the Purchasing Managers Index. So this is the people in all the big companies and all the small companies that are buying goods. This is a forward-looking indicator, and you can see how much it's recovered this chart goes back to 2008 for some countries, but you can see in Australia and the US in particular how that confidence level, which is what companies are buying, and I'm going to talk more about this, is looking extremely good. In terms of GDP tracking, the swift speed of change, Australia above. I've got another chart to come. We'll look at the whole world, what's happening there. But fair to say, good economic results. We've just had the March quarterly inflation numbers come out. They're incredibly low. In fact, 1.1%. So only up a fraction of the 0.9% that we had the previous quarter. And they're annual numbers. So we've got an inflation rate of about 1%. Not much change in the Aussie dollar, not much change in anything really here. At the margin, it's interesting, 10-year government bond yields, which had ramped up from 0.1% at their lowest, back up to about 1.69, pretty steady and slightly down at about 1.65%. But either way you look at it, an incredibly low interest rate world and hard to get a good return on term deposits, bank accounts, and even government bonds. Which is why a lot of people are looking to the share market, which will put a floor under the share market, although will cause some people to be in areas that they probably shouldn't be. A sneak preview of the returns for those of you that just like to get the summary. And look at the one-year returns. These are the one-year returns to the end of March. Now, these are kind of false returns because they show directly from the bottom of the market the recovery. So you'll see funds like the Core High Growth Fund up 35%. Everything good. That'll steady out as we level. Be very careful about comparing returns. Make sure you're comparing the exact periods like end of March 12 months to end of March, otherwise they're just way out at the moment. But you'll see, 3-year returns, which we're really happy with, are consistent with our targets and the numbers we use to plan. And we're very pleased with the portfolios, the core portfolios. Most of them are sitting in the top quartile and right at the top of the top quartile for their performance, continuing to do the job in which they've been designed. So those portfolios are designed around what we believe is the natural nature of the market. It goes through this cycle of boom, bust, wall of worry, or FOMO, fear of missing out, fear, and most of the time though, we're just worried about another one of whatever's happened before, another health crisis, another GFC, another depression. And during that wall of worry, and you can see it in the real market over here, we just wobble up the hill with occasional breaks as we worry about everything and anything. And during that period, we'll rate the market as either expensive, fair, or cheap. So they're the 5 statuses that we can have the market at, and of course, everything in between. And to give you the spoiler alert, we currently no change to how we rate the markets at the moment, at just above fair value. And I'll talk more about that. So that dial, as I said, just above fair value, hasn't changed too much. I've updated the backdrop to this slide here about this particular downturn. This was the 8 worst downturns on the right here in history. And when I say history, modern history, 1900 to 2019. And that goes back a long, long way. And I used to say every single one of those was caused by that market cycle, boom, bust. So we went to boom, or FOMO, and then eventually came the bust. This particular downturn we've just had was a massive exception. It was the first downturn of more than 20% that we had that wasn't caused by that market cycle. In this case, it was government intervention and a lockdown caused by a health crisis. I'm going to expand on that a bit more. We did go down 36%. We're pretty much back to where we were, not quite in Australia, but we certainly are in other parts of the world, but pretty close to the point where it's the quickest recovery in history from one of these downturns, from the big ones. One of the reasons why is the continued rollout of the vaccine, but the optimism there. And I've updated the slide from last month there because what I wanted to look forward to, and while the news is focused, as always, and as we know the media does, because that's their job is to make you watch. The way they make you watch is by reporting the worst news and pointing the camera or the focus on the worst of the worst. That's what they do. So obviously they're focusing on the worst stuff in India right now. And it is bad, there's no doubt about that. But if we look ahead and look at countries that have got ahead of the curve on the vaccine, and I think the US has actually surpassed the UK on vaccines now, but this was Israel last month, and you can see they had that massive sort of first, second, third, fourth wave, and then down it was coming as they rolled out the vaccine. And now they've got to the point where there's hardly any new cases coming through relative to the thousands that they were having per day, 10,000 a day at the peak, and now down to about 100 a day. So that gives us a clue about what's going to happen as we vaccinate the world, which is quite promising. We're seeing that in the UK as well, although still a stubborn amount there, but a much bigger population, of course. Israel has a relatively small population. And I added here the US, and we're seeing that decline, although stubborn cases as well, although death rates are dropping. So good news watching that vaccine rollout. Not so good news for Australia, where we've tripped over a few things. We haven't quite got our act together. Let's hope that's changing. It looks like it is. We'll report more next month, but hopefully as the vaccine rolls out, we get to participate in that as well. Not so much an issue for us in terms of recovery from COVID cases because we don't have any, but it's a real issue about us joining the world as they start to travel. We're seeing this week, Europe pretty much said to anyone from the US, if you've been vaccinated, come on over and become a tourist with no quarantine. So we're going to see this more and more. We'll get to see how that works, by the way. Maybe it'll work, maybe it won't work. But eventually, us Aussies are going to be sitting here going, hang on, I'm watching people from Canada, US, Europe travel and enjoy themselves. I want to do that too, but we won't be allowed to because we haven't got our vaccination act together. Hopefully that catches up and hopefully we get to join the party. If, and it's a big if there is that party in recovery, we'll wait and see. Continue on, why the speed of this recovery? And as I said, the speed of that recovery is caused by the fact that this wasn't triggered by any financial excess. It wasn't the normal boom bust cycle. We had a drop of 36, but it was driven by that intervention from the government that shut down the economy, shut down what we could do, and it stopped and turned around when the government started to respond with support. So stimulus, we've heard the word a million times, but there's two main types. There was the government spending, so this is money that the federal government actually spends, and that included wage subsidies like JobKeeper and other spending, and that government spending helped put into the economy what consumers weren't spending. But then the big one I want to touch on today is this federal bank response. So federal banks is the Reserve Bank of Australia, the Federal Reserve in the US, the Japanese Central Bank. And what they do, they run separately from the federal governments, and their job is to create monetary stability, stable inflation environment in the countries that operate there. They do that in a number of ways, and it's a whole textbook that I won't go into here. But one of the tools they have is that they can use their balance sheet, picture that as like a giant check account with an overdraft, to do things. They can put money back into the system. So you'll hear them talking about printing money. What printing money means in layman terms is just they literally pay to buy back government bonds. So the government borrows money to spend. So what they do is they go into the market and they buy those bonds back just by literally writing a check, so to speak. They don't physically write a check. So they can cause that to go into overdraft. You can see here, the US is up to $80 trillion of that overdraft. Australia, and that might be 800 trillion, by the way, don't quote me on the zeros. It's a big number. So we've seen that uptick since COVID, where they've literally doubled the size of their debt. So this is the Federal Reserve debt, not the government debt. So it's the overdraft that they have available to them. So they've literally doubled it. In Australia, we've more than doubled it. And Japan's been doing this for a while, and Japan's been trying to waken up their economy for about 30 years and create inflation. So this is nothing new, but all the major countries around the world have done this, and it helped the recovery. So it's a good thing in terms of helping the recovery. What we don't know yet is what results it will have down the track. Will it cause inflation? Will it cause increased government indebtedness? The OECD forecasts, by the way, are for this to level off in the next year. So they're sort of predicting the slowing down of that. We see the result of this, and when you look at the OECD, which is the Organisation of Economic Development, you'll see their numbers. They have some of the best economists in the world, so we often refer to their data. This is the change year on year for GDP. And the pink line, Australia, we do get a gold medal here. Our result on our GDP, we're actually above where we were a year ago, which is quite staggering and certainly not what anyone was predicting. The USA is almost there. Japan is there, and Europe and Great Britain are lagging, but only that 5 to 10% mark. And certainly you'll see that recovery there of all of those things. So that's a good thing. It means we haven't done that too much damage. What all that has led to is consumer and business confidence. We see that with that purchasing managers, that they're spending. So that confidence to spend is holding those economies up, and that confidence is critically important. And above all that, we saw that massive flexibility of people and business to change to an online world. People working from home, people talking to relatives, the Zoom /Teams / all the other ways of doing business online, increase in online sales from Amazon, Google, and all these other things. So that the economy changed rapidly, which is the sign of a very good economy when it can adapt to structural changes fairly quickly. Now, make no mistake, there's been casualties, and particularly in the hospitality and tourism area. So there's been casualties there, but there's been other areas that are booming that more than make up for that. In Australia, our federal budget comes down in 2 weeks, so it's going to be interesting to see the Australian government's projections going forward, see how much they've actually spent. So what is the deficit that they've built up? And that's that government response number 2 there. We'll get to see what that is. That tells us what the bill is that we've all got, including our kids and grandkids, to pay back a at some stage, and keep in mind, just before COVID, we just gotten back to no deficit. So, and that's okay. The government's had to do what they had to do, otherwise we would have been faced with a massive depression and job queues and soup kitchens and all that sort of stuff. We dodged that. Life for most people is pretty good. Unemployment is down to almost pre-COVID levels, quite staggering when you think about what we went through in terms of the sheer size of that drop in GDP. So yeah, speedy recovery, it's a good thing, but where to from here? So the OECD, on the left-hand side here, you can see their projections for recovery on 2021 and 22. And so for 2021, they're showing good growth. You can see Australia there at 4.5%. And just keep in mind, some of the countries showing the spectacular growth. One, they're high growth countries, but two, they were hit hard during that downturn as well. And for 2022, we see world growth at about just over 4%. We see Australian growth about 3.1%. That's a good number for us. That's a reasonable number for Australia. And importantly, we see the engines of that world growth, some of the developing nations and the US, in the 4s to 5s. So they're fairly good numbers, but the pandemic has left a hole. So this chart on the right shows where we're likely to be in Q4 21 compared to what we're projecting before the pandemic. So in Australia, for instance, we're going to be 2% below where we should have been with no pandemic. Now that's actually a good result compared to what we would have thought. And with all that money in the system that the Federal Reserves and the RBAs have pumped into the system, the outlook remains reasonably promising. And we think we're sort of in for a continuation of the slow growth world, which is good for investors. The wild card is inflation and interest rates. That's the big unknown. And depending on how that plays out, will determine how other markets play out as well. Onto our pillars and the results of the individual segments, but the care methodology involves breaking the portfolio up into 4 distinct segments built on a whole body of long-term knowledge from principles of basing on your plan, learning from history. As you see in these articles, we are massive students of history. That allows us to understand investor behaviour, where we're trying not to mess it up, and then we ultimately can then rely on good modern portfolio theory. Done well. That mess it up, the top 4 there, the mess, we're seeing in spades every single day. The media driving the public's emotions with that. Never before have we had a single issue of obsession like COVID, nor the short-term focus. We know these things for most people lead to very bad investment results, so congratulations to our clients who've sat with their investment strategies and reacted appropriately during this to the point where we've had really good results. So congratulations for managing your behaviour. And some of the other ones there. I'm going to dive into the results. So Aussie shares, once again, all the results I'm going to go through here, you'll see spectacular 1-year performances. But once again, look at the 3, 5, 10, etc. They're kind of boring as the way they should be. There's the 1-year chart, nothing but up. The 10-year chart, and you'll see here the top 10 components of the Aussie market, and on the right here, the fascination of the different returns that they've had from CBA, a 58% return. Keep in mind, all of these are off an incredibly low base. CSL actually down, which is fascinating. It had a stellar run though, so you've got to be careful what you count. You'll see some extremely good returns in the last 12 months from those top companies. In the US, similar story, 30%, that's in Aussie dollar terms, recovery, good long-term returns. This particular chart shows the companies you own as part of the core portfolio through VTS, which includes Apple, Microsoft, Amazon, Facebook, Alphabet. Now, Tesla in that top 10, Berkshire Hathaway, which is Warren Buffett's company, Johnson & Johnson. So some massive companies there. And you'll see the percentage of the portfolio of that percentage of net assets is a percentage of the US share market and of VTS, which we own in those core portfolios. In US small caps, 57% return for the year, staggering. Another great month, 5% and up a little bit since then as well. You'll see this is small caps. You probably won't recognise many of the companies there, although some of you who have followed the markets will see GameStop in there, which is the company that was bid up massively due to the online forums. It's dropped down a lot. It's in that small cap index, but note the low percentages here. So this is a great exchange traded fund to own in the right proportions, of course, because you literally own a couple, hundreds and hundreds of companies. You'll see the biggest company there is 1.4% of the whole portfolio. So massive diversification. We know that's one of the most important things for a good investment strategy. We've got global leaders, the top 100 companies in the world. So once again, you're seeing those FANGs, Apple, etc. This is in the active portfolio. And you'll also see in there, actually, a couple of non-American companies. We talked about the US ones before, but you'll see here Nestle. And actually, is Nestle the only? Looks like Nestle is just about the only non-US company there. So amazing. This is why the US share market has had such a good run, because the companies that are doing really well, a lot of them are US based, those online FANGs, etc. Another great performance there. Not quite as much, partly because of the US dollar issues, but look at the long-term return that's come out of these areas. So a very important part of the portfolio. Emerging markets, great year. Not as good as some of the other ones. We've still got them at fair value, and obviously emerging markets get bounced around a lot more. And emerging markets still has some mega companies. You look at the top companies here, companies like Tencent, Alibaba, which are like the Chinese, Google and Facebook. You've got Samsung, and you've got Vale down there, who's the biggest iron ore company in the world, not counting BHP and Rio Tinto. They're our competitors. Ironically, if Vale ever get their act together, and they haven't had a good couple of years, China will be knocking their door trying to buy iron ore off them, so they can put their thumbs up at us, or put their finger up at us, I should say. But Vale have not done that well over time. But the good news for you guys, in the emerging markets portfolio, you've got some great growth that diversified as well with the rest of the portfolio, and good consistent returns over the long run. So gold we have in the portfolio as an insurance, as a hedge. When everything else is going great, guess what? Gold doesn't, and vice versa. So this time last year, we had the opposite. Gold was carrying the weight. Gold was doing well while others weren't, which is why we only hold a fraction of the portfolio in gold, and will continue to do so. And allows us to rebalance. So as the market goes down, we buy more, we take some profits out of other areas. Let's get into property, which is certainly a hot topic. And it's hard to know how accurate the statistics are. And keep in mind, in Australia, we have state markets, capital city markets. But within those markets, there's different markets for suburbs, right down to streets. So the action will be diverse around the country. But we're seeing the change for houses here. You'll see, look at some of these numbers. Canberra and Hobart up 13-12% for the year. Brisbane up 8%. Adelaide 9, Brisbane 9, Sydney 7, Melbourne Square, but rising, looking at even April auction results. Not quite the same for units, except for Hobart. And I'll touch on, I'm going to take you through some trends in this and talk about this in terms of median price in a bit more detail than usual. But look at this, all green, nothing down. And it's probably fair to say it's still got hotter, although starting to slow down. If you look at the median prices for the capital cities, Sydney is now $1.3 million median prices. Now, if you think that sounds high, the Noosa median house price is $1.36 million. So a house in Noosa is more expensive than, well, the median house in Noosa is more expensive than the median house in Sydney, and certainly the rest of the capital cities. Melbourne knocking on the door of $1 million median value. The median is just half the properties are valued higher and half the properties are valued lower. And this is houses, so not units. But you'll see these growth factors. You'll see some inconsistencies. This source's domain, the last slide is CoreLogic. We're seeing some inconsistencies in data, and part of that's caused by how quickly house sales are reported, and the information and the smoothing that these guys have to do to get meaningful results out. Fair to say, though, that those markets, that a lot of these markets are hot, and you'll see that in a minute when we go to the heritage type data. I found this cycle courtesy of one of the property gurus in Australia, Michael Yardney, who provides fantastic information. But he's had this slide for a long time which talks about the property cycle. It's a bit like our boom bust boring or boom bust wall of worry, but in the property market it's often boom, not necessarily bust, but downturn and then boring. So in the long run, property just marches up the hill. But in the short term, there's three distinct phases. You've got this massive rise, which we get, and we're just seeing around Australia, particularly in places like the Sunshine Coast, a lot of regional areas at the moment, where they've just had, over the last year or two, including just recently, the gains for the cycle. Now, often at the end of that, the market either goes to sleep, or it has a downturn, or a stagnation, as Michael calls it, followed by an upturn. But here's the interesting point. If you're buying or selling, this is really critical. If you're going to be selling because it suits retirement planning or change of circumstances, the perfect time to be selling is at the end of the boom. And we never know when the end is, so it's somewhere in the latter stage of the boom. It's fair to say we're possibly there in some parts of Australia, possibly the Sunshine Coast. Maybe we've got some more to go. But if you're a long-term holder, it doesn't matter. You get to ride and enjoy the next boom as well eventually. But you may have to sit tight and see up to a decade worth of no price action, sometimes longer. We've seen that in lots of places. I'm going to show you some specific examples in a minute. So if selling a property is a consideration for you in the next decade, it's possibly a good time to be doing it now. The same as if you're thinking about buying, you need to be very careful. If you're buying in places that are somewhere up the top of the hill here, you may have not much return, capital return, for the short term. So still looking for places that have promise of upturn, just to make you feel better about the buying. As always, don't act on anything from here. Talk to us. We've got many property gurus we work with and try to make sure that we find you a good property where that's appropriate to your circumstances, particularly for those that are gearing for their wealth creation, our younger clients. Following from that is what's actually happened in the capital cities around Australia, and also from Michael Yardney, and he calls this a tale of two cities. So we cast our mind back to 2007, and the price of a Perth property and the price of a Sydney property were exactly the same. And we'd had a massive boom in Perth, driven off the commodities boom and the flight of people over to Perth to support the mining boom. We had flatline in Sydney, and as much as people forget this, Sydney was flat from about 2003 all the way to about 2009, so 6 years. So even the good markets of Melbourne and Sydney can have incredible flat periods. So at that point, Perth and Melbourne, were completely the same. Now, if we had perfect knowledge and hindsight, we would have been saying, wow, that's crazy. Let's sell our Perth investment property and buy a Sydney investment property. If you did that, you would have done very well. And you'll note Perth, this chart only goes to the end of March 20, so it doesn't yet show the COVID uptick. But Perth's pretty much been stagnant since. That's kind of 14 years in the wilderness for investment programs. A bit of joy, a bit of downturn. Hobart has been spectacularly up to the point where Hobart is now above Perth, is now above Adelaide, is now above Brisbane. Now, in my mind, I've got some very good friends and clients that are either from Hobart or retiring there. That creates a dangerous market right now. In my mind, there's no way, given the demographics, economic growth, etc., that Hobart would naturally be higher than Brisbane, Perth, or Adelaide in the long run. So be cautious when you're buying down there. But Brisbane's been quite subdued. And at one stage, Brisbane was tracking Perth. Brisbane and Adelaide have been fairly subdued. So there's reasonable optimism that Brisbane and Adelaide certainly haven't enjoyed the gains that we've seen in Melbourne and Sydney here. And we believe for those people buying investment properties that are looking for reasonable returns in the next sort of 3 to 5 years, the Brisbane and Perth markets are probably fairly good ones. This is a very individual decision when you're doing that. We can help you with that. Having said that, Melbourne and Sydney are blue chip cities in a blue chip country, and they will do well. It's just if you're buying into those markets, particularly given the COVID uptick, You may not expect gains in the next 3 to 5 years, but you would absolutely expect gains over the next 10 to 20 years. So hopefully some insights there into what's happened to property. Look at this. I've never seen this before. Pretty much everywhere in Australia is sitting in a rising market on the Untitled property clock, with a few exceptions. And it's interesting. It's regional WA towns which are there. So when markets recover, they start at the capital city and then they filter out into the regions. So Perth has kicked off its horrible time. It's moving up finally. So potentially a good time to buy because it probably is early in their long-term cycle. And we may see that gravitate out towards regional WA. Not that that's where we chase quality investment properties. Our preference is still always high growth capital cities. When I say high growth, high economic growth, high population growth capital cities, and a 2-hour drive around there. But look at this, everything up. And you know, Sunshine Coast 6 months ago, Untitled had it approaching the peak of the market. They bought it back, partly because a lot of these regional areas have been re-rated as they become more popular post-COVID. And the reason they're becoming more popular is because people can work from home. That means they can work from a regional centre, maybe head to the capital city for 1 or 2 days a week to catch up with the team. They can spend 4 to 5 days of the week in their beautiful region, whether that be the coast of Victoria, whether that be the Sunshine Coast, Gold Coast, whether that be the hills of around Sydney and beyond. But it's changed the dynamics. What we don't know is whether that's a dynamic that sticks once we get back into a relatively normal world. Is it a change that sticks, or will we revert back to wanting to live close to cities, etc.? And some will, some won't. Time will tell. Unit market, much the same, with the exception of a couple of North Queensland, well, with Sundays, and Sydney units. And keep in mind, Melbourne and Sydney units were hammered during COVID as people just did not want to live in the cities. So Sydney units on the bottom. Our cyclical nature would say that maybe that's a good time to be buying Sydney units, but just buy, beware, be careful. And as I said, Keith, good advice, talk to us. And Melbourne off the bottom there, but Melbourne units also took a hammering. But yeah, there's lots of changes going on there. So that's it as always. And just summing up, all good financial decisions are best made as part of a real financial plan. That's a plan where you've got your goals. The portfolio is designed to meet those long-term goals. We take a long-term view, but we're very interested in what's going on in the short term so that we can help our clients avoid making mistakes by reacting to the market and messing it up. The critical things which count along the way: diversification, asset allocation, and enough liquidity. We do access most markets, but not all, through low-cost index funds because that's what makes sense. We do like to see our clients protect against short-term volatility. So for our accumulators, that's people who are still accumulating their wealth in their 40s and 50s and beyond. That's dollar cost averaging. And for our retirees, it's having enough reserves to get through any crisis. And regular rebalancing, we've seen that work incredibly well during the volatility that we've seen in the last year. And as always, only 3 ways to lose money. Don't do them. That's panic and sell. Congratulations again. We have not had one client panic at the wrong time here. We brought on new clients, so unfortunately, because of lack of confidence in their world, we're out of the market and we're hearing stories, some of the people we're seeing or about to see cashed out at the bottom of the market. There's one client, one potential person in particular, they did a bit of the panic, they cashed out $1 million sitting in their super fund in cash since then, and they've now watched the market rise and to the point where they're kind of stuck in the market. It's a position you don't want to ever be in, and that's why we never want to time the market. In those 3 ways: panic and sell, have to sell, and not properly diversify. That's why we do all these things, to make sure you get good long-term results. I hope that's been valuable. Look forward to seeing you over the next few months as we catch up on reviews. And as always, if there's anything worrying, give the team a call, and always happy to talk. So until next time, enjoy, stay happy, vibrant and safe, but enjoy the wonderful world that we live in. McGregor signing out.